Hey everybody, Siddharth this side. I'm back with one more video, and in this video we are going to discuss about the load sheet setups, how to find them, and how to capitalize on those opportunities. So here I have listed some conditions, some points you need to keep in your mind before entering into a trade and confirming whether the setup is a load sheet or not. So, so basically, we need to stack the odds in our favor so that the chances of winning the trade is more, and the equation of risk to reward is favorable. The first condition is the buying force. Now, if I am looking for an opportunity to trade, one thing I have to keep in my mind first thing and foremost is whether the strong hands are interested in this counter or not, whether the institutions are buying this counter or not. So the best way to figure out that is the volumes and the magnitude of change in the price, obviously, which is accompanied by the volume activity. Now, moving ahead, we will look that in our charts. Now we'll move to the second point. The next point is location. We always want the odds in our favor. So we are going to stack multiple points so that the odds are always in our favor. Like if I find the low cheat setups near the moving averages, there it actually enhances the probability of winning the trade. Therefore, why do I need to risk my money if I am, if the probability is not high enough? Therefore, if I am going to risk my money, I am going to risk on very low risk areas. And where are those low risk areas? Probably near the moving averages. Now we'll see the character of the price near the location, but or on the location we need to find the unique character of the price, which is the price should be low in volatility and the volumes would be dry. Now low in volatility means the change in the range, or more precisely if I would have to quote it, it would be the range of the price throughout the day should be very less, and it should be accompanied by dryness in the volumes. So now there are, like, I have figured out two kinds of variations of the logit setups. The first one is, in this setup, if we look into the behavior of the participants of the markets, we'll figure out that this is these are the bases. This is the first primary base and then a secondary, a more contracted base. But something happens and suddenly price surges down. In like this sort of movements happen in very short span of time, and it actually kicks out many weak hands out of the markets. Now this sort of movement, it breaches the moving averages. In 2 to 3 days the stock would be 10 to 15% down. Then again we'll see an upsurge in price followed by a very tight range. Now, this is the location where we need to make a decision to buy or not. Now, this is the location where there is an equilibrium between the buyers and the sellers. Eventually, one of the party has to dominate. It could be sellers or it could be buyers. So, if we get early signs that the buyers are going to win the war, we will take our decision to buy the stock. Similarly, in the second variation, after the secondary base, in the in the process of the third base, there would be the location near the moving averages where the volatility subdues, accompanied by the dryness in volumes, and we need to figure out these low risk areas to make a decision to enter early into an uptrend. Likewise, here we are entering early into an uptrend. Now, going ahead, I'll show you some examples where we will find these kind of characteristics in the stocks. This is a chart of Hindustan Copper, and in this chart, you can see that this was a major base. No, this is a good base, but in this kind of a move where the stock is 15 almost 15% down in 4 days, violating all the previous pivots on the downside, this move actually shakes out many weak hands out of the market. But there is a unique follow move after this. You would see like there is no again follow through on the downside. Rather, we find this gap up followed by a big upsurge of 8% in a day. Now, this is the move that shows that the buyers are in charge, and uh, the down move could be because of any news, any event in the markets, or like there are many factors. But this kind of move from the buyers violates the theme that this kind of move had set up earlier. Now, the move after the upsurge is of most importance because we see that there has been a subdued volatility and price has been trading in a very narrow range, accompanied by the dryness in the volumes, right? But on this day, the buyers have again took the charge, and they actually broke the highs of last 5 days. Now, this is the point of inflection where the activity has again shifted towards the buyer side. And now we have to make a decision whether to buy this or not. Now, this is the low cheat area, and this is the unobvious buy point where we have to make the decision. Now, moving on to next example. This is a big base, and just look at this move. The stock fell for around 9% in a week. It breached the low of its IPO, and within 4 days the stock is up for 16%, followed by a tightness in the price. Again, 2 days of no activity. The stock has been trading in a very tight range, and then the buyers have confirmed that yes, we are in charge now, and the whole move is under their grip. This is one more example. You see the stock is up for 32% in the first 3 days after its IPO. Then it pulled back, but when it is pulling back, the volumes, the volumes don't accompany the move in the price, and we get a punch bar. Now, the punch bar, if you are new to new to this channel, let me explain you what's a punch bar. The punch bar is a day where the price has not breached the low of the previous day, and we see a point of inflection, the change in polarity in the price, where the price, the grip of price has been shifted from the sellers to the buyer's end. And on the next day, you see the buyers have commanded over the price and they have taken the charge, as they have breached the highs of the last 2 days and they have successfully managed to close the price above the highs of last 2 days. Now, this is the day where you need to make the decision to buy this. And then you see an upsurge. Likewise, now what is happening is we see a good base over here, and within 4 days, the price is down for 13%, violating the pivots of the base. And for sure, this kind of move would have shaken out many weak hands out of the market. But you don't see a follow through, and you see an upsurge of almost 10.5%, followed by a tightness in the price. Now, these are the days where the price has been trading in a very narrow range. There is no volumes accompanying, there's no significant volumes. And now on this day, the buyers have confirmed that the price is under their grip. So you, on these kind of days, you need to, make the decision whether to enter or to let it go. Moving on to other example. Yes. Now you see a small base over here, but again, price fell for 17.5% in just 2 days, breaching the pivot of this base. But we don't see a follow through, and what happens is price is again up for 17.5%, followed by a very narrow range for last 3 days. The volumes are below the average volume. Now this is the point of equilibrium between the buyers and the sellers, right? And now if tomorrow price gaps up, or it shows the sign of an early start, a strong start on the upside, that is the confirmation where we need to enter the trade. And we need, like, since we are entering in this trade and we are entering into a new possible rally at a very early stage, the risk of this setup is very low. And obviously this is not an obvious buy point, which actually enhances the probability of winning, right? So if you found this video useful, do share it with your friends. And in case you find any queries, any doubts, do reach out to me. I'm available on Twitter. You can also comment your queries in the comment box. I would be happy to address them. So that's all for this video. I'll meet you again in the next video. Till then, take care. Bye bye.